Welcome back to Investing Talk podcast, and Merry Christmas.
Today we're looking at D-Wave Quantum.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, let's unpack this. We have to start with what makes D-Wave different in the quantum space.
Right, because they're not really competing on the same track as, a lot of their big-name peers.
And that's really the core of the investment thesis here, isn't it?
It absolutely is. When most people hear quantum computing, they think of these huge, universal, gate-based systems.
The kind that are still maybe a decade away from being commercially viable.
Exactly. D-Wave, however, is focused on commercial quantum annealing.
Okay, so what is quantum annealing and why can they monetize it right now?
Well, think of it as being more specialized. It's not a calculator for every single math problem. It's more like an incredibly fast pathfinder.
For optimization problems.
No, precisely. It's built to find the absolute best solution from, millions or even billions of possibilities. Things like complex logistics, manufacturing schedules, financial modeling.
So this is the key insight you need to grasp. D-Wave is playing the quantum now game. They're not waiting around for the perfect, flawless system. They're making money from a system that's really useful for specific, high-value business problems today.
And the way they do that is through a hybrid quantum classical solver.
Meaning?
It means they use classical supercomputers to do a lot of the prep work, the data processing. Then they hand off the really complex optimization part to their quantum system.
Which lets them deliver actual measurable value to customers right now. That is a huge differentiator.
A massive one. And that strategy, it's given them a pretty significant first-mover advantage. We're seeing an early ecosystem start to lock in.
Yeah, I saw that. Over 100 organizations are already engaged with their technology.
And these aren't just, universities or research labs.
No, these are major players. Supply chain, manufacturing, telecoms.
It's a powerful moat. If D-Wave can convert those early engagements into full-scale paid contracts, they could lock in some of the most valuable customers on the planet.
That's impressive traction. But now we have to talk about the financials, because this is where things get complicated.
It's the classic early-stage story, isn't it? You have this incredible hypergrowth on the top line, but then these really steep losses on the bottom.
Let's start with the good news. Q3 2025 revenue was about $3.7 million.
Which is phenomenal year-over-year growth, over 100%.
And what's interesting is the market seems to think this can continue. Forward projections for 2025 are, close to 200% growth?
196.3% is the average,
Yeah.
And then still a very strong 55.8% for 2026.
So this isn't just a flash in the pan. Analysts are modeling a sustained hypergrowth phase.
That's the bull case, absolutely. But we do have to address the reported loss.
Yeah. The Q3 net loss was $140 million.
A staggering number. And for a lot of investors, you see a loss that big dwarfing the revenue, and it's an immediate, it's a red flag.
But this is where you really need to understand the details. That number, that $140 million, is very misleading.
It is. It was heavily distorted by a non-cash warrant liability remeasurement.
Can you break that down for us? What does that actually mean?
Sure. So like a lot of companies that went public via a SPAC, D-Wave had warrants. When the stock price shoots up, the theoretical liability of those warrants also goes up on the books.
Because they might have to issue shares at a low price.
Right. It's an accounting rule. But the critical thing to understand is that it's non-cash. They didn't actually, write a check for $140 million.
Okay, so if we strip out all that accounting noise, what was the real operational cash burn?
The number you want to look at is the adjusted net loss, and that drops all the way down to $18.1 million.
Still unprofitable, obviously.
Yeah. Oh, absolutely. But $18.1 million is a much more manageable number. It's what you'd sort of expect from a company in this phase.
And the big question then is, do they have the cash to support that burn rate while they scale up?
It looks like it. They have a strong balance sheet going into 2026, so there's runway there for R&D and sales.
I also saw they did some warrant redemption recently.
They did, which simplifies their capital structure. And that's a really good sign because it reduces the risk of massive dilution for shareholders down the road.
That's really important context. Okay, let's pivot from the fundamentals to how the market is reacting. The stock's performance in 2025 has been Well, explosive.
It really has.
Huh.
We're looking at year-to-date returns of 267%.
And one-year returns are almost 380%.
Yeah. That kind of move isn't just retail enthusiasm. It suggests a really deep structural shift in how institutions are viewing their strategy.
And you can see that in the trading volume.
Definitely. There was that recent rally, 16%, closing above $31. But the key detail was the volume.
Over 28 million shares.
That's not just noise. That's big money. That's fund managers building up their positions.
The technical chart seems to back that up too. It's been setting a clear pattern of higher lows.
Yep, with strong support building up around that $26 to $28 range. And the fact that it held its gains above 30 after the news broke, that suggests this is a real breakout.
And right on cue, the institutional validation starts rolling in. We've seen a sudden flood of analyst coverage.
That's right. Jefferies kicked things off with a buy rating and a $45 price target.
$45.
Yeah. And they specifically called out the ecosystem, those 100-plus organizations, and the upcoming Advantage 2 product.
And then Wedbush came in with an outperform rating and a $35 target.
Still very bullish. And the takeaway for you is this. When top-tier firms start covering a stock this aggressively after it's already had a huge run,
It means their research teams are telling clients to get in or add to their positions,
it provides a kind of safety net of validation under the current price.
which leads us right into what's next. The next few months are just loaded with catalysts.
Absolutely loaded. And it's all going to either validate this momentum or, derail it.
First up is right away in January, CES 2026.
On January 7th, this is a massive visibility event. They'll be showing off their hybrid solvers and, more importantly, telling real-world customer success stories.
This is where they have to provide the proof.
Yep.
Show that those 100 organizations are getting a real return on their investment.
Exactly. Then, right after that, we'll get the Q4 2025 earnings report.
Late January or early February. And while the numbers matter, the real focus will be on the forward guidance for 2026.
Guidance and the commentary. What are they saying about the sales pipeline? Are those pilot programs converting into bigger multi-year deals? That's the key.
And then there's the hardware catalyst, the Advantage 2 product.
Slated for some time in Q1 or Q2 of 2026, this is the engine for future growth.
Right. Jefferies even called it out as the key driver for accelerating customer adoption. Better hardware means they can solve bigger, more complex problems.
And one last thing we can't forget is government contracts.
Ah, yes. They formed a new business unit just to target the U.S. government.
Given the focus on national security and technology, any kind of federal contract win would be a huge high-margin catalyst, something to watch for in the first half of the year.
Okay, so we've laid out a very bullish case. The quantum now strategy, the growth, the validation, the catalysts. But we have to look at the other side. What are the risks?
And this is important. The biggest one is execution risk. Meaning, despite having over 100 engaged organizations, the company is still pre-profitable. That quarterly revenue is still only $3.7 million. The path from engagement to scalable revenue, it's still unproven.
So, if I'm playing devil's advocate here, why is revenue only $3.7 million if 100 companies are using the tech? Does that mean they're all just running tiny, cheap pilot programs?
That is the absolute heart of the risk. That's the concern, that customers will just keep these as small R&D projects and delay signing any really significant contracts. That's the wall D-Wave has to climb.
And the second major risk is just valuation.
Of course, any stock that runs up 267% in a year is going to be stretched.
The margin for error is slim. Any hiccup, any delay with the Advantage 2 product could trigger a really sharp pullback.
And we have seen some reports of insider selling in late December.
Which could just be profit-taking after a huge run.
It most likely is, but it's still a small warning sign. It shows that if sentiment turns, that same momentum that carried the stock up can carry it right back down.
So what's the mitigation here? Their whole strategy rests on being different.
And that's it. The quantum now play is their defense. They aren't tied to the same long-term risks as the gate-based systems, but it makes these next few events, CES, the Q4 earnings, call absolutely critical. They have to show that the pilots are converting.
Okay, let's bring this all together. D-Wave Quantum is. It's a fascinating story.
It is. You have this differentiated commercial strategy. You have hypergrowth over 100% year over year. And now you have significant institutional backing with targets up to $45.
And the next 3 months are packed with catalysts that could drive the next leg up.
The confidence level is solid, but it has to be tempered. That's purely because of the execution risk we just talked about and the valuation.
So what does this all mean? The challenge for D-Wave is simple. Convert all that amazing potential into profit.
Into scalable, repeatable profit.
And the one metric to watch when that next earnings report comes out isn't the headline revenue number.
No, it's the commentary. Specifically, the commentary on the conversion rate of those 100-plus organizations.
That's the signal.
That conversion rate is the signal that tells you if this whole commercial quantum thesis is real, and if it justifies the momentum we've seen. It tells you if that ecosystem is temporary or if it's permanent.
If you want to stay on top of the shifting landscape of quantum computing and track those critical conversion metrics with us, make sure you're subscribed to the show.